Okay, hello everyone, it's William DeBoyk here for pibjunkies.com again. We're going to be talking about part 2 here on how to trade Forex. Now, we mentioned in the first video a few basics, we went through a few bits of information, we talked about quote currencies, base currencies, going long, going short, briefly what spread is, things like that. Now, in this particular video here, what I want to talk about is the effects of that any trade that you're going to be placing. Now, there are other things to take into consideration, but a lot of them are situational. Rather, it's going to depend on that particular trade, that particular situation. So I'm going to be talking about two factors that affect every single trade that you're going to be placing. In fact, the second one on this will not affect everyone, and I'll talk about that when we get to it. But yeah, we'll focus on this for the time being. So first of all, margin trading. Okay, now what is margin? Basically, think about it this way. Okay, now whenever you buy something, the best example I've sort of explained to people is with eggs. When you go to the shop, you can't buy just one egg. Well, perhaps in some shops you can, but that seems a bit strange. You're going to be buying them in cartons, boxes, whatever you want to call them. You can be buying them in packs of 6, 12, whatever it may be. Now, we would call this a lot of 12. Okay, so you're buying a dozen eggs, a lot of 12. Okay, now in Forex it's exactly the same thing. Okay, it's stupid in Forex, just as stupid. Well, unless you need one egg, but it seems stupid to buy just one egg. And in Forex it's the same. Why would you buy just £1 or €1 or $1? Why would you sell $1? 1 Swiss franc, whatever it may be. Why would you do that? It doesn't make any sense. You're not going to make. Sure, you can make money from it. But realistically, the electricity that it's costing to power your computer is going to, it wouldn't even be practical for you to do. It's not even worth your time trading just one. But basically, what margin allows you to do is to trade things in higher lots. Now, lots, as well, as I say, keep in mind, okay, lots are like a dozen. Okay, a dozen means 12. Now, a lot in Forex, you have 3 different types of lots. You've got micro lots, mini lots, and also standard lots. A micro lot is 1,000 units of any particular currency. A mini lot is 10,000 units, and a standard lot is 100,000 units. So, for example, a micro lot could be $1,000, it could be 1,000 yen, it could be £1,000, it could be 1,000 Swiss francs. A mini lot could be $10,000, 10,000 pounds, etc. A standard lot could be $100,000, 100,000 pounds. You get the idea, okay? Now, you might think to yourself, well, I don't have £10,000, I don't have £100,000. Whatever it may be. Forex is very accommodating to people with, lower capital to put in. Now, it's not a good idea to trade with, undercapitalized. And once again, I'm sure we'll go into this in more detail at a later date. But Forex basically allows you, margin is what allows you to trade with borrowed capital. Okay. So margin trading is simply the term used for trading with borrowed capital. And this will apply to everyone unless you're absolutely stinking rich. Okay. I mean, I'm talking, you're going to have a good, hundreds of millions to be able to trade without margin trading, okay? At least realistically, okay? So margin trading is basically just that. It allows you to trade with borrowed capital. Now, it's not a debt. It's not, you're not loaning the money. You're not borrowing the, well, you are borrowing the money, but it's not a loan as such. You're not signing any paperwork. You can't get in debt from it. So yeah, it's basically borrowed money. Okay, now margins, for example, I mean you could trade $50,000 with as low as $1,000. Okay, you can trade $1,250 with as low as $25. It's the leverage, which once again we'll be going into more detail in this video series, but in the next video, exactly what leverage is. But that's what allows you to trade at the margin and the leverage involved within that to trade more money than you actually have. Okay. So I'll try and give an example of this, and hopefully this will make sense. Okay, so let's just say that you expect the pound will be going up against the dollar. Okay, so you open a trade with one standard lot, which would be 100,000 units of the pound versus the dollar. Okay, so you're buying the pound, and this is say you're buying that at a 2% margin. Okay, you want the price to go up, of course, because you're buying. Now, when you buy the one lot, so the 100,000 units, this is say you're buying at a price of 1.5000. Okay, so you're buying £100,000, which is worth $150,000. Now, me saying this, you may think, okay, well, why don't you have this up on the screen? I'll have something up in just a second. But as with most of these, in fact, every single video we do, if you look at it on our website, there'll be detailed wording of absolutely everything that I'm saying here. It won't be a transcript as such. It will just be what I'm saying and, you know, put in different words written underneath the video. So check that out if you're at a bit of a loss with this. I can imagine keeping this in your mind would be a little bit confusing. Actually, in fact, I have this here, which will help a little bit, perhaps. So you're trading that, okay? So we're trading the $150,000 worth, £100,000 of English money. Now, if the margin requirement was 2%, then you would only need $3,000 in order to trade the $150,000, okay? So you can control £100,000, in other words, with $3,000. Get it? So that would be on a leverage basis of 1 to 100. So every pound you have, you can control 100. So if you've got $1,000, you can control, sorry, that would be on a 1 to 50 basis. So $1,000, you can control $50,000. $2,000, you could control $100,000. In this case, $3,000, you could control $150,000. In other words, the 1 to 50 would be a margin of 2%. So you need 2% of any particular money you trade. So 2% of 150 is 3,000. So we'll be going in this in a lot more depth at a later date. But this is just so that you guys get the basic idea of this. So this just say in this example here that I've got on the screen now, you buy £100,000 worth, $150,000 you lose. You expect the price to go up. It goes up from 1.500 to 1.5050. You then sell. You say, okay, enough is enough. I want to come out to trade. You've just made yourself a profit of $500. And that's basically how it works. Okay, and then the way it's done. So you close the position. Any calculations are done, and you know the difference is figured out, and the difference is credited to your account. Simple as that. Now then, the next thing that traders will experience, and this is when you hold positions overnight, and this is something called rollover. And rollover basically is because you're borrowing currency, okay, or you're buying one currency and selling another, interest will naturally occur. Okay, now no matter which country you live in fact, I don't know if this is true for the whole world, but it's true for at least the developed world. Any currency you live in, there's interest rates. Okay, Bank of England have got an interest rate, the Federal Reserve, whatever it may be, you know, European Central Bank, they've all got their own set interest rates. So if you're placing a particular trade, the interest rate comes into account, okay, at that particular time, overnight. So if you're buying a currency with a higher interest rate than the one that you're borrowing from, okay, then the difference in the interest rate will be positive. Okay, and we actually have examples here. And vice versa, if you're, you know, going against it, then the different rates could be negative, and then you'll have to pay for that. So, for example, if you're going to be placing a trade, this to say that you're going long on the Australian dollar against the Japanese yen. Okay, we can see here the Australian dollar has an interest rate. This is current, okay? Keeping in mind when you watch this video, the interest rates may have changed, so don't take this for gospel. Interest rates, they don't change all the time, but they do change fairly regularly. I mean, it'd be uncommon for, say, you know, a 4 or 5 month period to go by without interest rates changing. And especially at the moment, a lot of countries have started to tweak their interest rates. Eurozone only changed their interest rates a few months ago. The UK's thinking about it. They'll probably change them by the end of the summer. We've got Australia's been changing quite regularly. Then we'll probably see New Zealand start to come back up to 3% again. Things like that. So, you know, we need to keep these things in mind. You know, don't take this as gospel. This is accurate for today's date, but this may not be accurate at the time that you're watching this video. So just keep that in mind. But for example, if I place a trade on the Australian dollar against the Japanese yen, I can see current interest rate on the Australian dollar is 4.75%. Current interest rate on the Japanese yen, 0.1%. Therefore, I'll be gaining interest on whatever particular money I have on that particular day. Now, the simple way to think about this is, say you have an interest, you know, savings account with your bank. They'll pay you money, typically every month. Some banks in England do every quarter, but a majority do, you know, they'll pay you a little something every month. You're basically getting that, but on a daily basis. But you're not getting a month's worth in a day, you're getting a day's worth in a day. So, you know, if 5% over the year works out to be 365, this is make it easy, let's say it's $365, your rollover rate each day would be $1. So every day that you have this trade open, you're getting paid $1. Now, some people do trade actually profitably to based on the different variations in interest rates, and we'll go on to that later on at a later date, and how you can actually use that to your advantage. But keeping in mind, every trade that you place has interest rates. Now, I did mention at the start of this video that there is actually a way where swap rates do not occur. Now, keeping in mind these rollover interest rates typically won't really make a difference in your trade unless you're holding positions open for a very, very long period of time, and they can, gradually wear away at your profit or even increase your profit. But usually, if you've only got trades open for a couple of days, which is what most new traders will be doing, it won't really affect you at all. It's nothing to really worry about too much. Now, there are some examples where you don't have to pay interest rates, and they're typically on the Islamic accounts. I don't know the full ins and outs of this, and I don't want to offend anyone at all, but I guess there's something, some religious reason as to why they don't pay interest rates. I guess I should know, but I'm afraid I don't. So that's one way you can do it. You can set up Islamic accounts if you wish. Well, if you're Islamic, I guess, and that would be a way to avoid the interest rates. But I say interest rates can go for you, they can go against you. You can use them to your advantage. It's something definitely worth taking a note of and keeping in mind. Okay, then. So we'll round that off there now, and I'll speak to you guys in the next video. Thank you.